So we've spoken a lot about getting started investing, but what do we do as we get older? Common logic dictates that as you approach retirement, you should reduce your allocation in stocks and shares and increase your allocation in safer investments like bonds to protect ourselves. There's even a rule that everyone loves to quote which goes along the lines of 100 minus your age and you get the percentage of shares versus bonds you should own. All of this really is a debate on risk and how to effectively manage it. So today, let's talk about that.
Risk used to drive me right up the wall. I used to say, what if this happened? And on top of that, if this was to happen, look at the fix I'd be in. I better not try. Then I'll tell you what changed my whole life when I finally discovered it's all risky.
The year is 2004. Ashley Revel stands on the gambling floor of the Plaza Hotel and Casino, Las Vegas, about to do something that most people would consider mental. He's just spent the last 12 months of his life selling all his worldly possessions, leaving himself with nothing more but the clothes on his back and $135,000 in cold, hard cash. Ashley turns to the crowd who have gathered around the table and asks,
"What colour then?"
have you ever heard a more nervous laugh than that? Ashley picks red. And it pays off. Ashley has instantly doubled his money in what will become an iconic moment in gambling and a perfect example of risk and reward for us to use as the backdrop in today's video. The funny thing is, he sold his flat in Essex to help fund the gambling for about £75,000. If he'd have kept hold of the flat, it'd be worth about £400,000 today. But don't worry, he used the money he won to invest in a new business, a gambling business, but it did fail 12 months later. The reason this event is so captivating is because the risk and reward profile is so clearly defined. Ashley is either going to double his money or lose everything. Simple as that. When it comes to the stock market and our own investment journeys, the risk reward profile is not so clear. The reason people invest is because long term they expect the markets to outperform, say, leaving your money in a jar at home. And for the last 116 years, they've been pretty much right. But the one universal truth that we all need to understand about the stock market is we can't predict what's going to happen. No one knows what's going to happen to the stock market day to day. The only thing that we can control is how much risk we accept from the stock market. The problem is, how risky do you want it to be is a rubbish question. Get two guys in a room. One is a skydiving shark wrestler.
He wrestles sharks with his bare hands.
The other is a stock auditor from Scunthorpe.
It's exciting, it's a fast-paced work environment. It's a big rush out of it every day.
You ask them on a scale of 1 to 10 how risky they'd like to be when it comes to investing, and they both answer 5. The problem is, to the shark whisperer, a 5 out of 10 is surfboarding in shark-infested waters at dinner time, whereas to the auditor, a 5 out of 10 is having a hot at Nando's instead of a medium. There is no universally accepted tolerance for risk guide or level.
We're doomed.
We're not done yet, Chucky mate, don't worry. What we can do today is we can explore some traditional wisdom and look at some more modern day thinking so that we can see if we can come up with a more common sense approach on how to address risk and cope with it going forwards as we develop as investors and grow older. The main thing is, I will give you my opinion today on how I'm going to approach risk going forwards, but that doesn't mean your way of doing it is wrong. Your appetite to risk is your own. Just because you do something differently to me doesn't mean you're wrong at all. Let's start with the traditional approach. We can all probably agree with the logic that when you're younger you can afford to take more risks because ultimately you have more time to recover. As we mature we become more aware of our health and safety, we stop thinking we're invincible, we drive slower, exercise more, and we stop climbing trees. So the traditional logic has always been when you are younger you take more risks and as you get older you reduce that risk. In investing that's typically achieved by increasing the allocation of bonds you have versus stocks over time. So you start off with a higher amount of stocks when you're younger, and as you get closer to retirement, you water that down with an increased amount of bonds. The whole concept is called de-risking, and is something most financial advisors will build into their advice when structuring a financial plan for an individual. Speaking of financial advisors, I'm not one, so you definitely shouldn't listen to a word I say. Everything that I'm discussing today really is just for entertainment purposes, although it's beyond me why you wouldn't just watch Netflix instead. If you do want financial advice tailored to your own specific circumstances, go seek out a good financial advisor. And if you do want something that's a bit more entertaining than me, I hear everyone likes Line of Duty nowadays. Bonds are simply just a form of loan to a government or business. They pay you interest on the loan and the amount back at the end. So the standard message is you invest and save for your whole working life, and then as you approach retirement, you increase the amount of bonds in your portfolio, and then reduce the amount of shares, thus reducing the risk of your pot of cash being hammered in value by a drop in the stock market. You are literally watering down the effect of the shares on your portfolio by adding those bonds. And the reason that this logic has become so ingrained and mainstream over the years is that traditionally, upon retirement, people would take their investment pot, all the funds that they had, and they would buy something called an annuity with it.
What?
Okay, so say you have £500,000 in retirement savings and investments at the point you come to retire. I might turn to you and say, okay, give me that £500,000, I'll then give you £25,000 a year for life up until the point that you die. With the more money that you have, the bigger annuity you can buy. That very simple relationship between the amount of cash you had and the ability to buy a better annuity led to the relationship towards risk and the concept of de-risking. That meant as you approach retirement, the main priority became protecting the pot of cash you'd already built so that you could secure that lifetime bag. On screen now is a table, and it shows the average yearly returns of investors who invested in the S&P 500 between 1970 and 2019. The table shows a low, medium and high allocation towards the S&P index, with the rest being made up of bonds. So the 20% has 20% of their cash in the S&P 500 index, and the rest is in bonds. The person at the bottom has everything in stocks. Now, while past performance is no guarantee of future performance, this table provides clear evidence that over time, if you accepted a higher level of risk by going for more stocks, you received a higher level of return. But that really isn't that surprising, is it? What I want to focus on here is the 12-month column on the right-hand side. So we can see here that the individual who held 100% of their stocks over that time period would have had to have stomached a 12-month period where the value of their investments dropped by 43%. The individual with the bonds got a significantly lower rate of return, but the largest drop in value over a 12-month period was only 9%. From a traditional thinking perspective, the risk the stock market presents is not one of poor performance long term. It is instead that a high exposure to stocks when nearing retirement could lead to a dramatic decrease in the value of your pot of cash and thus reduce your ability to buy a good annuity. So you hit retirement age and the time comes to secure an annuity. You go to sell everything in the stock market and then you realise the markets have just so happened at that point to have crashed 43%. When you hear rules like take 100 or 110 and minus your age, and that gives you the proportion of stocks versus bonds that you should have in your portfolio at any point in time, in my opinion that's a historical logic built by generations of the past that were gearing themselves up to buy an annuity at retirement. A more modern take on things. There's a few problems in my opinion with the traditional logic of de-risking. The first being that returns on bonds at the minute are awful. In many cases they are below the rate of inflation, meaning investing in bonds could produce negative returns. Or to put it simply, you could lose money holding them. Add to this the fact that the flexibility on how we can use our pensions has increased, and that it's no longer the case that annuities are the most used product anymore. Due to a perfect storm of low interest rates and increased life expectancies, the amount that the annuities promise to pay now was also reduced. Think of it this way, if annuity takes a pot of cash and gives you a guaranteed income either for life or a fixed period of time, you now live longer, so that pot of cash needs to stretch further, so the amount the annuity can pay you has reduced as a result. This has been reflected by the dramatic fall in the popularity of annuities. This isn't backed up by science or anything, but I was talking to a mate of mine the other day who happens to be a financial advisor, and he also has a YouTube channel. His name's Tom.
Hi.
Hi Tom. I'll link his channel in the end cards and put it in the description below because it really is a great channel. You should go check it out. But basically he was saying that as a financial advisor, in the past he used to do an annuity a week for his clients. Now in the last 7 years he's done 2.
Actually, mate, it was 3. He never listened.
So if annuities are no longer that popular, the question I ask is, why are we still doing a de-risking strategy that is aimed at producing one singular pot of cash at the point of retirement that we then live off? We now live longer than ever before and the trend seems to be rising. Let's face it, 60 is no longer old when you consider you now have a 30% chance of living until you're 90. That means if you start investing at 30 and you retire at 60, you have a 30% chance of your retirement being as long as your whole investing timeline. The main risk modern investors face is having enough money to last them until they die. It's for this reason that it's my opinion that a modern investor should continue to remain invested heavily in stocks throughout retirement and should focus on continuing to grow their portfolio whilst drawing down an income from it, not just replacing that portfolio with a load of bonds or just turning it all into cash. I do think when you're younger you should take more risks. And as you enter retirement, it may be sensible for you to reduce the risk of your portfolio. You could use bonds to do this, or it could just mean swapping out companies in your portfolio with a high risk to reward profile.
Needed.
One measure you might want to use when considering how risky a business is when putting it into your portfolio or deciding to remove it at retirement is something called beta. Beta is like a measure of volatility versus the rest of the market. So it simply measures how much a share price moves compared to the rest of the market. To find it, simply go on a website that provides financial information on companies, Yahoo Finance for example, search the name of the business you want to find and you'll find the beta here. With this, the stock market beta is 1, so anything less than 1 moves less than the stock market and thus is potentially less risky, but also potentially has less returns. Anything above a 1 moves more than the market. The higher the number, the more volatility and the higher potential risk-reward profile. Personally, I feel that I'll be invested in the stock market heavily until the day I die. My version of de-risking would be looking at my portfolio at the point of retirement and identifying any stocks that I feel would add risk to my portfolio and maybe replacing them with more stable stocks with a lower beta, switching out an Argo blockchain and putting in a Coca-Cola, whilst also still relying heavily on my globally focused index funds, which you know I'm a massive fan of. You might say, what if the markets collapse, Damien? Well, I would reply to that by saying, as I approach retirement, I'm going to ensure that I have a pretty large emergency fund. Having a couple of years' worth of living costs saved as cash at the point of retirement will mean I can lean on those funds if markets collapse, reducing the strain on my investments. I will then top that emergency fund back up when the good times are rolling. A focus on swapping stocks for bonds just because that's what people say you should do could lead to you getting rid of your high-performing stocks in replacement for low-yielding bonds, which is a bad idea. But as with anything, especially investing over long periods of time, things might change. I might be sat here in the future looking at you going, right, bonds are amazing now, we all need them. But the key thing is, rules like take 100 and minus your age are too set in stone. They don't look at current market conditions, they have no flexibility in them to take into consideration the performance of those asset classes at the minute. Retirement is a flexible concept, with people taking on side hustles or even returning to work after retirement. Just look at Pete and Baz. Hello, darling. If you don't know who that is, I feel sorry for you. But yeah, it always pains me when someone in their 50s reaches out to me in the comment section and goes, Damien, what am I going to do? Life's over. I'm about to hit retirement. I haven't got much in savings. It's too late for me now. Instead of thinking of it like that, consider the fact that you have a 30% chance of living for another 40 years. I wouldn't expect a 10-year-old to say to a 50-year-old, oh, you know, I haven't decided what I'm going to do with my life yet. It's over.